And so so we are just running a few minutes behind. I'm really excited that so many of you have continued to stay on. As our next panel joins and makes their way up to the stage, Gerron, you are first, so you get an A+ and credit. Campbell, you were late as per usual, just second place. We're missing a couple more. If we can get our panelists to join us here on stage. And let me, while I have a moment, Michael Burdick, I appreciate that question. If those of you who don't know, the Michael that asked the question on the last panel is one of our closest and dearest friends in the California legislature, who has served, I think, the California constituency and the fintech industry for a number of years, and has been a close friend and collaborator with OLPI, MLA, and obviously now together with AFC. So Michael Burdick, a shout out to you and for the amazing work that you're doing in California. Thank you. Scott, Orson, and Lisa, we are waiting for you. Are you here?
So Phil, I'm here. This is Scott. I just can't share. It's not allowing me to share my video.
Same here with Lisa. It says I'm not able. Okay, here we go.
There you go. Okay, Tammy's listening. Don't worry. Tammy is there. You go. All right. Thank you all. So I'm excited again with AFC to share together on a board with amazing companies and amazing friends, and obviously Gerron, who is a powerhouse, a former legislator and a powerhouse at AFC, who is going to try and corral this group into a panel. And so, Gerron, I wish you the best of luck. It ain't easy. I wish you the absolute best of luck. They're great, but they're complicated sometimes. So good luck, especially that Campbell guy. So
like herding cats. Good afternoon. I'm Gerron Levi, Senior Vice President, Head of Government Affairs at AFC. I know personally as a former state lawmaker who also worked on the consumer advocacy side of financial services post-crises. I really wanted to know the answer to this question. Are emerging fintechs reaching the underserved? As the nation's banks consolidate at a breakneck pace, banking deserts proliferate, and the credit needs of the low and moderate income, borrowers of color, small businesses, and rural consumers go unmet. What do we know about bank fintech partnerships? Well, in 2018, researchers at the Federal Reserve Board of Philadelphia found that 25% of loans of one of AFC's largest members were concentrated in the 10% of communities with the fewest bank branches per capita, which are disproportionately low income and enabled lending to invisible prime consumers whom other lenders might overlook or overprice. They found in 2019 that low default rates were achieved while serving people deeper in the risk spectrum than customers of over 85% of the top traditional banks. Researchers at the GAO, Federal Reserve, and National Bureau of Economic Research reviewing the COVID-19 Paycheck Protection Program have documented the role of bank fintech partnerships in reaching underserved businesses, making more PPP loans, zip codes with fewer bank branches, lower incomes, and larger minority populations. We have a great panel today representing three companies that can really speak to the breadth of how neobanks and bank fintech partnerships are serving the underserved. Scott Astrada, Director of Government and Community Relations at Affirm. Orson Aguilar, Senior Director of Public Affairs at Opportune. Lisa Violet, Chief Auditor at Varo Bank. And Campbell Gibson, Head of Public Policy at Avant. Welcome. Please share a little bit about your bank fintech partnership or your business model, your product, and how your company is serving the underserved. Scott, why don't you start?
Yeah, happy to kick us off. Thank you, Gerron. The best place to start is with Affirm's mission. Very direct. We offer honest financial products that improve people's lives. This really is the bedrock of Affirm's products, Affirm's services. The prime example is that never in the history of Affirm has we charged a late fee to any consumer. This is pursuant to a categorical policy we have of just we do not charge late fees. Not only is this a driver of consumer financial health, but I think it really is an embodiment of what we mean by honest in terms of aligning the consumer interests with Affirm and that we don't benefit, we don't make money unless a consumer successfully repays that loan and chooses to come back to us. So this, alongside other principles of transparency, a 30% cap on any product we offer, many of which are actually 0%, no hidden fees, no gotcha fees. This is what we mean by improving people's lives, that we empower our borrowers to have the tools and the flexibility to manage their financial health. Now, I'll just end with tying this to the LMI and underserved. One of the main priorities that I have, that one of the things that is embedded in a firm's mission, is ensuring that a firm's growth, technological innovation, is tied with financial inclusion. How do we ensure that financial inclusion is a bedrock of our development in terms of the underwriting models, the risk assessment, and we recognize we don't exist in a vacuum from a social impact point of view. We face obstacles of historical discrimination. Many times underserved means actively excluded from a communities of color point of view. From a financial services marketplace, there's high cost lenders, predatory lenders that are detrimental to consumer health. So as we look at underserved borrowers using an expansive definition, we are ensuring that we are tracking, analyzing through measurable metrics and benchmarks how a firm is a part of the solution in terms of being an option and alternative for individuals, many times that don't have many credit options and are right in the crosshairs of some more predatory or dangerous financial products. So look forward to the discussion, and thank you all for having me.
Thank you, Scott. And Scott, Affirm is a buy now, pay later company, right?
Yes.
One of our great emerging technology. Lisa, Neobank.
Ron, thank you so much. And it's wonderful to follow Scott, because this is a very diverse panel in terms of the different segments of the consumer solutions and problems that we are helping with. So Varo Bank, our business model is basically from within the system. We were very intentional about being a consumer-facing fintech that is America's first ever all-digital nationally chartered bank. We, with intention, did that because the founder, Colin Walsh's desire was to have a new way of banking. And that new way of banking was basically to focus on who has not been served by the traditional system, and then migrate everybody, whereby Varo is a bank for all. We do not charge fees. We do not charge for having credit application for people coming on to use our small dollar lending. We, since we opened up, have subjected ourselves to the standards of the system. Some of the earlier panels talked about how very important the collaboration and the oversight is with all levels of government, whether it be federal, state, and the different arms of the regulation. So we are basically upholding and subject to the standards, because whether or not one is a chartered bank, federal or state, all of us are systemic. Systemic because we're solving a problem. And at Varo, I want you to say also, representation does matter. We do have one of the most diverse boards, one of the diverse executive teams. I'm part of the executive team. And our rank and file and our vendors, we really want to make sure we're close to the customer and understanding what problems they have that we need to solve. I'll end with respect to our business model. All of us, the more we get into it, the more we learn. With the more data, the more future forward technology. So for Varo and for all the participants here at American FinTech Council today, I'm looking forward to our partnership with the industry and with government to how we continue in the United States to show how we can serve all Americans.
Right, thank you. All right, Orson.
Hey, everybody, good afternoon. It's good to be with AFC today and with some great colleagues here. Explaining opportunity, I always start by explaining my parents' credit journey in this country. My parents came here from Guatemala. They only had, their belongings in their bags, not even suitcases. And I remember the first purchases they made were with credit, usually store credit, layaway programs. But it turns out none of those forms of credit helped them build credit scores. So when they did have to turn to credit because they needed a loan, They were banked, and the bank refused to give them a loan. So they went to a predatory lender, and they lost their life savings at one point. And Opportune is a company that serves people like my parents. Half of our customers have no credit scores. Majority, 90% of our customers have historically been in LMI communities. We are a community development financial institution certified by the Treasury. And we provide three basic products: an installment loan, a secured loan, and a credit card. All are capped at 36% MLA. We do it with many consumer protections. We provide free financial coaching through our partners at Unidos US to all our clients to come through our doors. And lastly, I'll say we have aspirations to be a bank because our communities need more banks. I see where Opportune is. I don't see that many banks there. We see a lot of very high cost lenders there. We just issued a new report that came out yesterday showing that an Opportune loan can be as 21 times cheaper than the loans typically given to folks like my parents in that story. And so we have aspirations to be a bank. And lastly, what I'll say is I'm proud of our diversity. We have a Latino CEO, which is rare to see for a public company. We have a very diverse board of directors. 8 of 11, in fact, of our board members come from historically disadvantaged communities. And what I'll end is we're always looking to do more for our customer base because there's a deep need there. We see credit deserts growing. Again, we heard earlier about 26 million people that are unbanked or don't have credit profiles. There's a lot more that we can do to bring folks into the financial mainstream.
Thanks, Orson. All right, Campbell.
Hi, thanks, Gerron. Thanks, Gary, Phil, AFC for having me today. I think it's a great event. As Gerron indicated, I'm head of public policy for a Chicago-based digital platform called Avant. We partner with WebBank on a number of products, including an installment loan, credit card, and secured product. And we'll soon be going into a deposit product as well. Our goal is to offer a full suite of products to a dramatically underserved population, which is the non-prime, subprime, near prime population. This, by varying analyses of sort of FICO levels, ranges from a third to almost half of the American population, which is hard to imagine that such a large number of people could have problems finding quality credit on, as Lisa said, a systemic basis. You know, this is not a niche. This is not a small portion of the American public. It's an enormous, almost majority of the American public. And what we found is when people talk about underbanked populations, that there's an enormous overlay with non-prime, and the geographies where you see underbanked populations, such as highly dense inner cities or urban areas, are much more likely to have high proportions of non-prime. And so I think that we're looking at a population that systemically, as Lisa said, is facing a dearth of options. And Avant and other fintech companies are coming into those areas and offering high quality, simple, transparent products, which are able to provide people a real lifeline in many instances, where the only other the real options are storefront lenders or high rate lenders. And so I think that it's an important story, both from like what fintechs are doing from an economic standpoint, but also from the policy standpoint as to like, how do you approach that? How do you foster that?
Thanks, Campbell. You are all doing your own industry research and surveying your customers about their credit needs, why they are seeking a loan or seeking your particular products and services. What have you learned about serving low and moderate income customers or borrowers of color, underserved consumers, and geographies? Orson, why don't you lead us off? I mean, you're a CDFI, you probably, have some direct experience.
Yes, as I mentioned in the introduction, we are a CDFI, meaning every year we have to, look through our data. As I mentioned, historically, 90% of our customer base comes from LMI communities. Half of our customer base has no credit file, which is where our technology underwriting system really allows us to make not only a quick decision, but a safe and sound one to make sure that the customer can truly pay us back. As we also mentioned earlier, historically, our average customer makes about $30,000 a year and is the primary head of their household, meaning that they're using that to carry their entire family with something that low, which we know is really hard these days. And we also look at, of course, what our community members see on the ground. And so I mentioned the study with the Financial Health Network that we just released yesterday. And by the way, we do this regularly because we want to see what the experiences are between our customers and what they see, and found that our loans can be 26 times cheaper than alternatives in the communities. And so, when I drive, I'm based here in Los Angeles County, when I drive around and see where our store locations are, and I see who else is there, I definitely know that our rates are a lot lower. Again, a lot of the consumer protections we have are better, and that, we're not going to refinance folks at certain limits. There's a lot of things that we have. We've listened to the advocates, met with the advocates. I'm a former advocate of, doing 20 years of advocacy to bring fair credit to communities. We make sure that, we're abiding by all that. And frankly, we're also a member of AFC. And what I appreciate about AFC is that we have certain principles that we all abide by. So those are some of the things that we look at when we look at our customer base to make sure that we are truly reaching into those underserved communities, and in particular, those LMI households.
So Campbell, I know you all have you've also done a lot of industry research and customer surveys. And what do you know about your LMI and underserved customers based on, what their credit needs are and why they're seeking loan?
Well, thanks, Gerron. I echo many of the things Orson just outlined. I do think that what you find is that the lives of those who are credit challenged or LMI don't look, maybe it's not surprising, don't look a lot like those that have plenty of financial options. But the challenges they face in getting those are not just the fact that they're not a lot of banks necessarily in their neighborhoods, but it's that their work schedules are much more challenging. They're often meeting childcare needs and family needs that other families may not have. They're working potentially more than one job. And so in many instances, it's the reason that a digital interface really works for people that don't necessarily have high comfort level in financial or positive financial histories, interactions, I should say. But it's also, if you're working until 11 o'clock at night, then that is your option. And it also, I think, goes to the uses, which we see are often very different. While there is a fair amount, a substantial amount of debt consolidation, debt refinancing among our customers, we also see a lot of use where you're looking at urgent need that can't wait a week for a decision, money that's needed immediately, and it's non-discretionary type of uses, household emergency, childcare, your child is sick and they have to be treated immediately. You don't have savings. Your transmission is out. You need to get to work with your car. So these are not discretionary uses, and I think that's part of the frustration. People that are in this background and people that serve this background, people with subprime credit feel discouraged because these are not, these are very much sort of make or break decisions for people, and they're not in a position to source a lot of options, and they need credit, responsible credit in an expeditious fashion. So I think that is, why there's been a real uptake in products, sub 36 products serving subprime customers.
Okay, thanks, Campbell. Lisa, what are you finding?
Yeah, we found three things. The first thing we found, actually, to inform why we created Varo and made it a full service bank, all digital. The second will be what continued to inform the product offerings we have. And the third is a study that we did with Aspen that really was line of sight for us as we extend our credit product offering. So let me start with the first study that we all are very familiar with, but continues sadly to be the reality. In 2018, the Federal Reserve did a report that 40% of Americans could not cover $400 expense. As Campbell said, this is not a niche market. This is a very significant portion of the American consumer base. So when we looked at opening up Varo, we definitely said a new way of banking where our banking products would not be subject to service charges and all of that. And we help people start the habit of putting aside a little so to live within your means. So we have always and continue to offer high APY savings. And it's those that actively use their Varo account and live within their means. They're covering their expenses and they're active. And so they get the benefit of that 3% APY. It's not offered to those that don't do anything and just put hot money there to get a high yield, right? That 1% of American that's just optimizing. So we really were intentional about our core banking saving product offerings to really address that Federal Reserve study. Okay. The second piece is January of this year, Bankrate did a study that affirmed something that we already knew. 39% of Americans only 39% can cover through their savings, $1,000 emergency, $1,000. And that's with savings. So with our savings product and those habits, those financial habits, you want to teach somebody how to fish, not give them a fish, right? So these are the building blocks of what we do. And we continue with these building blocks. We just recently announced a collaboration with EverFi across the country. We're really going to do this financial literacy to scale, building upon our foundation. With respect to our own proprietary work that we're doing and studies, December of last year, we did a piece on banking for change. And this was about speaking with our customers, with our research team, getting what's public domain as well as proprietary. And we learned three things. The first is because a lot of people are taking from Peter to Peter poll and don't have enough coverage for $400 emergency fund or $1,000, savings account. We heard from people that they want ready and quick access to their paychecks. The establishment already has it, right? There's real-time payments now. There's no need to hold up people's money if it's available. So we actually, as soon as the payers make people's paychecks available, we give it to them and we don't charge a fee. We're not saying you have to pay a fee to get early access. It's there. The system is there. Have your money so you can get to managing your life. So that was one of the first things we heard from consumers from that Aspen work that we did. The second is because of the demographics and the chronic lack of savings, people want to have access to short-term lending at a good price. As Orson said earlier on, AFC, all of us that are here have a commitment to transparency and making sure that we offer to the consumer more affordable offerings. And people want short-term lending. Not everybody wants $10,000 to go buy a car. Some people want $800 to buy a TV or a washing machine or something small to treat themselves. And they want basically short-term lending. And this is an area of policy where we're really going to have to get deeper into the bowels of that. And the third is something that really is exciting for us. And that is Americans, the underserved, the LMI, the credit invisibles, of which there are 45 million of them. They want credit improvement programs. They want to learn how to fish, and they want to get credit for good behavior. Traditional models, traditional systems, the incumbents are solving and serving a different consumer with a different set of behaviors, and this has to evolve. So we just recently issued Credit Borrow Believe, which is an innovative credit building type of product. And these are all products that are looking at the state of the economy, looking at the experience of the Americans, looking at the demographics, and coming up with solutions to kind of serve. So I'll just end in summary, like the three big takeaways here from my perspective is, all of us came together for FinTech to say what problem is trying to be solved. And it all begins and ends with, average American does not have $400. Second is, do we reward the getting to make money off of your investment portfolio? That is not only for the very wealthy. Everyday Americans should be rewarded, even in a market of flat interest rates. So you could appreciate this. If VAR is giving 3% APY, we are investing in the consumer and rewarding and building that behavior whereby you get that savings and you are able to do things with it. And third, the reality is people need credit, right? That's why the banking system exists. Whether you're shadow banking or not, people need access to credit. And we want programs that use tools and data and scoring methods and design a product to reward Americans, whether it's $50, $1,000, $10,000, or $100,000, that we have solutions for all.
Okay, thank you. Scott, do you have, what can you add to this?
Yeah, so this is all great and really supportive of the work of the fellow AFC members. So in an effort not to be kind of duplicative, I think we all share a lot of the same mission. But what's exciting at Affirm is to be kind of at the center of innovation, the expertise, the proactive boldness in terms of developing financial products, from our cornerstone bank partner installment loan to our split pay, zero interest, 2-month biweekly product, to the savings account we just rolled out, to the Affirm debit card we just rolled out. The most exciting part for me is for all that to coalesce in a mission of improving consumer lives. And then how does that impact LMI borrowers and being proactive? And, from an investor relations, from a business viability point of view, you have to measure sustainability, growth, profitability. So that's necessary. But you also have to measure what usually doesn't get measured. And if you're proactive and bold enough to see who's using your product from an LMI, low and moderate income point of view, communities of color point of view, and analyzing that data and ensuring that the growth of companies and the sector is inclusive in terms of product offerings. Similar to what I said in terms of we don't exist in a credit vacuum. We like to think, and this is the research is ongoing, and we'll for every person who gets an Affirm loan, that's not an installment loan or a payday loan that they would have to get. And that gives me a lot of meaningful purpose in my work. And similar to Orson, I'm a first generation to live in this country, first generation born here. And within 2 weeks, I remember being on the wrong side of the worst actors in the financial service industry. Like as a kid, I remember opening the door to staffers from a high rate installment company that literally walked in and walked out with the couch. Because my dad signed a contract that he didn't speak the language, and I'm sure was very problematic in terms of a transparency point of view. So what I would add to just kind of add thematically to it is that I think what we've learned in my experience with serving LMI and underserved borrowers is you got to have credibility and dignity. Credibility is, does your product do what it says it does? Results, not promises. Who's using your product? Who's being empowered by your product? And there are very objective measures you can use to that. And are you kind of getting off the sideline for that? And dignity to the point that I just said is, vulnerable consumers need protection. They need to be protected from the worst actors. But the flip side of that is communities that have been marginalized need opportunity. Young entrepreneurs of color, individuals trying to find their own American dream, the interaction you have with them stays a lifetime. The bank account I've had for 30 years is the one that I opened for my mom translating with a bank teller, and they were the only bank that would accommodate someone who didn't speak Spanish. And I've had that bank account for 30 years, and that's an essential aspect that empowerment has to come along with protection if we're really being serious about this.
Well, we have maybe about 8 or 9 minutes left, and there are a couple of Q&As in the chat that I want to get to. But I do want to ask at least two of you this question about challenges or the biggest policy challenges you see on the horizon for your company, and specifically your ability to better serve underserved customers in geography. And I think I'm going to direct this to Campbell, and I know Lisa, you had some pieces on small dollar loans, but let me start with you, Campbell.
Well, Lisa already touched on some of the challenges around various small dollar products. I'll leave that maybe to her, although I do think that is an enormous challenge. I mean, generally, I think from my perspective, I come out of a policymaking role in the Senate and U.S. Treasury post-financial crisis. And so I think regulators looked at subprime and non-prime from a lens of safety and soundness, and often those products were intended, as Scott said, to be traps or non-transparent at the very least. And so I think shifting the view of this enormous swath of the country is not being served, and how do you approach it from a policy perspective while still being mindful of sort of history and safety and soundness, I think is a challenge, a real challenge, and one I think that regulators and policymakers are taking serious steps towards addressing. But I think that, if you look at AFC and if you look at neobanks and bank partnerships of varying stripes, there are a lot of novel ways that companies are coming up with partnering with banks, or in Vara's instance, becoming a bank, or even some state licensed lenders that don't partner with banks, coming up with new ways to approach these. And I think that regulators and policymakers really need to sort of drill down on, how do we differentiate responsible from predatory, and how do we unpack this that it's not just a bank or a non-bank, but it's going to be increasingly the combination of those or some variation on those that really, I think, when you get down to it, it's a question of how do you from a supervisory point of view, and as Representative McHenry said, making it clear to those that are participating in the market, how do you differentiate responsible from predatory? And I think in some instances, that's going to be an important differentiation versus like whether you're a bank, a non-bank, or what particular charter form you hold.
Thanks, Campbell. And Lisa, if you can, maybe in a minute or less, sort of give us your top lines on policy challenges on the horizon.
Yeah, there are a few, but the top three for this moment in time, I think first and foremost, a lot of consumers are using payments. The gig economy, it's just the way people spend. So for a lot of the neobanks and for incumbent banks, what happens around interchange in Durban is a core part of how we serve our customers. A second policy matter is open banking and data access. Prior panels today talked about just how important open banking is, and that access to data really helps a level playing field. So if incumbents want to double down and hold their ground, it's really going to encumber the consumer. So open banking is probably one of the biggest policy matters. And Campbell did a really wonderful job of covering the small dollar lending. I won't add to that further, but definitely the cost of offering a $50,000 loan, you just do it once and you have all that coverage, is different than offering somebody $50, $500, $1,000. And we've got to better understand that. And as we help Americans build credit, the last policy matter will be credit reporting and FCRA. And I just want to end with this. We are very fortunate to have a policy-driven trade association for us to have these conversations collectively. And VAR is looking forward as being part of AFC to really engage on these policy matters.
Okay, we do have a couple of questions to Oscar.
I'm happy to be. I'll be.
I'm sorry,
Oscar.
to Orson.
Yeah, I'll
I'm
jump
sorry.
in on that.
How
Yeah,
does
first-
that's with it? Okay. How does Opportune actually determine eligibility for credit invisibles underbanked?
Yeah.
And
So
you
there are
answer that in a minute. We're running out of time.
Sure. So first off, there's a few questions there. One is our charge-off rate is hovering at 6%. Two, we use alternative credit, alternative data to determine, right? And so a lot of the typical companies are, I'd say they're too lazy to look at alternative credit, right? Looking at, again, have you been paying your rent on time? Have you been paying your phone on time? Credit references. We go out of the way to do some of the things that other lenders don't do because they have found it to be expensive. We've been able to do it because we have an automated system that allows us to do it fast and safe, again, pointing to that 6% charge off, which is really low and very comparable to most major banks. So that's my quick answer.
Thank you. And Brent had a question for Scott about buy now, pay later products. Are the products profitable even when customers pay on time?
Yes. So I'll give my under a minute response and take 5 seconds of that to say this is a longer response. But ultimately, if we think of Affirm not as a product, but a platform, it allows risk allocation and cost sharing across the merchant, Affirm, and the consumer so that we shift the costs from the consumer to the ecosystem. And what that means in kind of plain talk is that the way the revenue streams from a 0% APR loan are either from a merchant discount rate, from a consumer acquisition cost point of view, from the interest-bearing products, obviously it's the interest carrying, and then kind of the finance side in terms of securitization and secondary market aspects. So the one takeaway I would stress is that the consumer always knows what they're paying ahead of time when they sign up for the loan. And each one of these loans allows Affirm to carry on its mission from a profitability point of view and also a mission point of view. So there's a lot of complexity behind the scenes, but yes, every loan brings Affirm one step closer to its mission in terms of profitability, growth, and our mission-driven, honest financial products. You're muted, Gerron.
Sorry, thank you it's been a great conversation, and Phil is on the line, and I'll turn it back over to you.